Well, our speaker today is none other than Michael Stevenson. He's finally done with tax season, so he has time for us. So we're going to learn a little bit about accounting. Okay, Mr. Stevenson provides audit, tax, consulting, and other accounting services with emphasis on manufacturing, retail, wholesale, and transportation industries. He also serves the tax and financial planning needs of individual clients. He earned his undergraduate degree from Columbia University in 1980, his master's in business administration from the University of Puget Sound in 1981, and a master's of science in taxation from Golden Gate University in 2008. He joined Brink Sadler in 1982. Became a stockholder in the firm in 1996 and serves as vice president and secretary. Prior to joining the firm, he served 11 years with the United States Army, retiring in 1995 from the Army Reserves with 24 years of service. He is a certified management accountant and a chartered global management accountant. Mr. Stevenson holds a license to practice in the state of Washington, issued by the Washington State Board of Accountancy. So please welcome Michael Stevenson.
Who is that guy?
He sounds impressive.
Hey, how receive this?
Yeah.
Can I get a CE credit for this?
Yeah, you know, you should probably do that for us.
Except it would be long enough to put everybody to sleep then.
I can do that anyway.
Always a trade-off, I guess.
Yeah, you can straight up. Can you tell if this is working or not?
Nah.
No? Okay. Today I thought I'd talk about the new regulations for depreciation and repair regulations, actually. And it covers a whole lot of stuff that most people have no idea about. Some of our clients found out about it this year when they did their tax returns and had charges for election and new policies for them. So what we had to do for most of them, this is actually started December 23rd in 2011, but the IRS didn't make it effective until January 1st of 2014. And so what happened is a lot of people thought they weren't going to have to do this. They thought they'd get it changed before then because it was way different than what we're used to. What they had decided is the IRS said, look, everybody's expensing everything they feel like. They're calling it repairs, they're calling it maintenance, they're calling it everything you can think of, and they never capitalize it, they just expense it all. And so we're tired of going to court and proving that what they did wasn't what should have been done. So they came up with some terms and changed their definition slightly, and then came up with some safe harbors for small businesses, which is what most of our business are. There's definition of a small business is they have under $10 million of sales per year. So that makes them a small business. Which I think is everybody, pretty much. We have a few over that, but not a lot. And that's what averaged over 3 years. So for each of 3 years, you have to be over the 10 million on average. The basic regulation that's going to be changed is Internal Revenue Code 481 is where most of it comes from. And it's also regulation 1.62.3T for some of the stuff. Each one of them has a different one, which doesn't mean anything, so we'll kind of skip over that. The big terms now is a unit of property. And that's the definition of unit of property is let me get the right term here. Because that builds on everything else. Whoops. Okay, for buildings, it's a unit of property can be the heating, the ventilation, the air conditioning system, the HVAC, plumbing systems, electrical systems, all escalators, all elevators, fire protection and alarm systems, security systems, gas distribution systems, and other structural components identified in the published guidance. So what they're saying is you have this huge building that, and usually these buildings are $1 million or more, which we do have rentals that are that big. I mean, apartment complexes and most commercial. Then what they do, instead of depreciating the whole building, they divide it up in all these sections. Now you have to have a survey done to do that properly and come up with that. You wouldn't do it unless you were going to have some major repairs that you know about, because they did allow you to take each one of those sections, and this is for the bigger ones mainly, and expense up to 40% of that particular asset. As long as you were under that, they were going to allow you to make that a repair. The example they used was this building had a HVAC system with 10 compressors, and they actually replaced 4 of them, and they were able to expense them. If they would have done 5 of them, they would have had to capitalize it, add it on the depreciation schedule, and depreciate it over 39 years. So it makes a big difference. And that's the deal. Anything you capitalize on a residence, not anything, most things that you capitalize on a residence is 27 and a half years. And I mean like a rental resident or an apartment complex. If it's commercial property, then it's 39 years. So it makes, it doesn't help a lot when you spend $100,000 and you're only getting a couple $1,000 expense out of it. So that's one of the reasons people were not too happy about this. They came up with some terms: betterment, that means to correct material defects, a material addition, physical enlargement, expansion, extension, reasonably expected materiality increase, strength, production, efficiency, quality. All those are considered a betterment. And each one of these has different rules as to what you can do with them.
So a betterment, you can't write it. A betterment, you have to add on appreciation.
Right, all these are things,
The repair will be written off.
yeah. And then a restoration is the other one, and most people know a restoration of damage. So if it was damaged and you fixed it to make it like it was before, that gets capitalized, unless it's a casualty loss, and then the basis gets adjusted. And it's also a part or a combination of parts that comprises a major component of the building or a piece of equipment. Problem with these rules is they always make them for big companies that have all these things that we don't. An adaptation is capitalized amounts paid for adapting something. So if you took a garage, theoretically, and turned it into a rental property and put in a bedroom and everything you need, that's an adaptation. You've changed the use of a garage into a living space for a rental. So that would actually be capitalized, and you'd have to go with that. Don't panic yet. Okay, and that's true with equipment. If you had one that used it for riveting, people just use this, had a tractor came and by or a track coming by, and they were just riveting everything, and then they didn't need that anymore. They changed their product, and now they comes down the belt and they paint everything. Then that would be an adaptation, and you couldn't, the extra expense you did to fix it, so that would do that would also be capitalized. Okay. Small businesses are the ones that most of us deal with in small property. So under $1 million as far as the value of the property, it would be still in that category that you wouldn't have to worry about, or you probably wouldn't be worthwhile to do the unit of property. So on those, they have the safe harbor, which is the one we elected for most people. And there's two rules, of course. And it's again back to, well, not really bigger companies, but if you have an applicable financial statement, which basically means if you have an audited financial statement on that company every year, or if it's a government entity and they have a reviewed statement, then they can make a safe harbor and expense everything up to $5,000 per line. Okay. If you're not, you don't do financial statements and you're a small business, you get to expense up to $500 per item. So what that means is for most rental properties, you have to be real careful how your invoices are done. Because if you have a new asset, say you buy a refrigerator, a stove, and a dishwasher. If you lump them all into one invoice or one number and say that's it, then it automatically, you'll have to capitalize it. If you separate it by lines or even invoices, and each one of those is under 500, including the installation, then you could expense each of those, or maybe one or two of them, and only have to pick up one of them. So that's one of the things you're looking to do.
Mike, if you buy something like that and then have it installed separately, you have to combine the two prices?
Say that again, if you buy something,
Buy the refrigerator and then you pay somebody separate to install it, you have to add the two prices together, or can you have them as two lines?
you probably should add them together and put them in there, yes. So no, it doesn't, as a matter of fact, they have a rule in here for that too, which I don't remember exactly where it is, but it basically says you can't abuse the policy. So if you did something like you bought something for $50,000 and you told the guy, hey, wait, just put it on 5 separate invoices, or more than that, it'd have to be, let's say it was $1,500. Put it on 3 separate invoices, $500 each, and then I'll just expense them all and be done with it. If you do that and you get caught, there'll definitely be some penalties for doing that. So you have to be careful what you can do. Now,
Isn't that like fraud?
yeah, that's kind of what they usually call it. I didn't want to get that serious.
Prosecute you for fraud.
But you know, there's fraud everywhere. Fraud's the most prevalent thing that happens in any business. Every single business in the world has fraud, and they have theft somewhere. People taking stuff that's company property and using it for something other than what it was, the reason they received it.
So on the tracking side, on our end, what do you label stuff? How do you label it to separate it? Improvement, betterment, or?
Yeah, well, you have to look at what it is and then decide which of those are. And then if it's going to get capitalized, you just say whatever it was and add it to it. It can be an betterment or an addition or whatever it happens to be. You don't have to use those words in order to put it on your depreciation schedule, if that's what you mean.
Oh, yeah. As well, we did a lot of work on the rental house last year in Florida, and it took several months. And so with all of that grouped together as one remodel?
Oh, remodel's fine. But that's all going to get capitalized then when you do it that way. Now you might be able to pull out the appliances that were under 500 on the invoice. Of course, a lot of times that's hard to do anymore because you can't find anything that costs less than $500. But you want to put in your apartment anyway.
Mike, before you move on, I have a question. So were you saying that it has to be under 500, or just that if it's under 500, it's automatically safe harbor?
if it's 500 or less, and you make the election and the election has to be made every single year, then it's automatic. The IRS can't argue with you. It's just there and they're done. They can't say, well, you should have capitalized this for whatever reason. And there's been cases where they've tried to get people to capitalize smaller amounts. Now, we still have the Section 179 and the other rules that we can use for the assets that they pertain to. So that's still there, but this is more for expensing stuff. But then they have some other neat little rules that really cause people heartburn, and I'm not sure how they're actually going to fall out. But they're saying per unit of property, you have to take the lesser of 2% of the asset's value, book value, what you paid for it, or $10,000, whichever one's less. So that's where you get into a problem with buildings, because if you bought a house 25 years ago and you paid $40,000 for it, now the most theoretically you can expense is $800 in maintenance and repairs. And you just go, oh. And of course, all the accountants in the world are already working on ways to get around all this. And one of them, they're really pushing to make this one, instead of 500, to make it 5,000, just like the other one is. And I'm sure the other companies that are doing audits are going to try to get them to go up much higher too, to make it a little more reasonable for what they're doing. Now, if you don't elect into this, you can use the other methods, but then you're just open to the IRS saying, hey, we don't like what you did, and we want you to capitalize all this. And then you have to argue with them and see what you can get. If you can't get anything, then you end up going to court or through an appeals system first and then into tax court. And when you go into tax court, you have to pay the tax first. And then if you win, they let you take it back. So it's not a deal where you can get more time to come up with the money. They made sure of that.
Mike, I'm sorry, I probably the only one who doesn't know what this is, but what do you mean by capitalize?
Capitalizing is what you do with a piece of property that has a life of more than 1 year. See, anything that has, like this chair, should be theoretically capitalized when they put it in here with all these others, because they should have a life over a year, and actually the rule would be 7 years for the tables and the furniture here. And that means you can't just take the whole thing the first year. You have to take it over a 7-year schedule. And we have accelerated methods that we use for that. Matter of fact, the first year is like 40% under acres, no makers. So they let you take 40% in the first year. And then it goes down from there, and the last year you're getting a lot less because it's not worth what it was. As soon as you buy it, it depreciates tremendously.
Is IRS creating like a mass quantity of extra work that needs to be done for doing that?
Yes, and matter of fact, they backed off because initially, everyone who made this election would have had to file a Form 3115, which is about 10 pages of all these questions. And they could have had to file up to 3 of them. But finally they came up and said, okay, all the small business elections doesn't have to do it. And that just happened like February. I mean, we were already in the process of doing some, and then they stopped it and said, okay, we're not going to require that, because they knew then that they were going to get probably, 10 million of these forms coming in, and they don't have the manpower to go through them and see if they're filled out. And they're new to most people. It's a change in accounting method. So most of them would be filled out wrong to start with. So they'd be corresponding back and forth with at least 500,000 people, trying to figure out, get them to do the form properly. And all of the elections have to be done in the year, whenever the return was due. So if you did it, if you didn't do an extension, it had to be done by April 15. If you extended it, then you could have it to the extended due date to make that election. If you go past that, then you can't make the election. You just have to wait until the next year to try to make it. And this election is every single year that you would have to do it in order to get into the safe harbor. And that's generally where people want to be, just because they don't want to wake up one morning and get an IRS notice that says, you know, we're auditing you because of your Schedule C or your S corporation or your partnership assets. What do you mean by that? You mean their equipment, is it?
Just take some of these independent contractor, like in the financial industry, if they're purchases that they're making for home offices or whatever, all fall under this small business category.
Right, they'd still be in that same category.
So you have to make an election even if you don't have any applicable expenses?
No, you don't if you don't have anything in that category, but that means you have no repairs, no maintenance, you know, and you haven't bought anything new for the year. And we get quite a few that don't. Every couple of years, they don't buy any assets. But not a lot.
If you have a home office and and you say it is 10% of your house is your home office, and then you do some like furnace or heating or that kind of thing. If you go by 10% of the, let's say it's $1,000, would you?
It would depend where it was. If it's in that room, then you could probably do that. As long as, and it depends on what it benefits too. If it only benefits that room, then you, like for instance, if you had a garage that you converted and made that a home office, and then you had to put a heating system in it and heating, air conditioning, and windows or something, then all of that would fall into those categories. And you'd have to, and that would again just be a remodel in most cases. They also changed, or didn't change, they had the definition for materials and supplies. I went so far as to do all of this, but I wasn't going to talk about it because it really doesn't affect anybody unless you're in a manufacturing business or something similar to that, where you have a unit of property under $2,000 or a jet engine that's sitting on the shelf. You know, you can't expense those, you have to wait until they're used, and then different things. So it goes into inventory, what you can have, what you can't. And they have special terms for that also. Yeah. Exactly, no. And you know, the big rule on that is you can't have a home office if you already have an office. So, and that's where doctors got in trouble because they were the ones that were the biggest, they're the ones that caused all those rules for home offices. Because they were all saying, hey, my home, I go home and write up all this stuff, use my computer and do all that, but they don't meet patients there. They don't do most of their work there, and they usually have an office or an area of the hospital, if they're working in a hospital, that's theirs. And so the IRS said, no, you can't have them.
How would that work for somebody like me, who's got an office to go into, but I don't pay for the office, so I don't have an office space there. My office is in my home, but I do go in to get my mail, go to a meeting.
Could you use the office?
Yeah, I could if I wanted to pay an extra $500 a month.
Okay, so if you'd have to pay more, then I'd say you don't have an office. in that case. Yeah, that's right on the, right at 55. But it's there, I think you're okay because you don't actually have the right to have it unless you pay for it. 4 minutes? But I have 3 hours more stuff. No, I don't really. All the important stuff is, out there. Basically, you just want to make sure that when you buy something for your rental properties or your businesses, that you get them itemized on the list. Another trick they came up with, if you're tearing something out, that is separate from installing it and putting it in. So even if it's the same people that come in and tear out all your rugs, you can expense all of that. Because that's, tearing out and going to the dump versus actually installing the new rug. So that's another thing. If they give you a bill for the whole thing, you say, no, please separate these different items for me, and then you'll be able to come out better on your taxes that way.
Is there anything for any allotment for the time that you put in?
Personally, no, and there never is, because you don't pay yourself anything. And if you think about it logically, it's kind of like people say, well, my rental didn't rent for 2 months. So, I want to, so what do they usually want to do? They want to,
Write it off as a loss?
yeah, they want to write that rent off as a loss. Well, if you never got the rent, you can't write it off as a loss.
Opportunity cost.
Yeah, it doesn't work. Now, if you want to pick up the rent and include the whole year's worth of rent in your return and then write off $2,000, you could probably get by with it, but it wouldn't make any sense. And that happens quite a bit when you get that question.
Finance on something, you need to be.
Well, I don't think any CPA would do that for you anyway. That's like 70 miles an hour. Or more, maybe. Any other questions?
Does the IRS have a section on the webpage that will let us know if you can deduct something or not? And there are several times when I do.
Well, they have every form and every,
That's a nice one now.
yeah, and every pamphlet, that they have is online. And you can just go to their main page and you go to pubs and tell it what subject you want, or you go to regulations, or, everything's there. It's just a matter of getting to it and then understanding it, and it's so ridiculous. They give you those little charts that tell you how long it takes to fill out a form. Well, some of those forms, it says 11 to 15 hours, and it's one page. What? Why would I want to do that? I wouldn't spend 11 hours reading a page just so I could fill out one. I'd just figure it out. Yeah. But those things are ridiculous. And sometimes they say they're real short time, and they're not. They take a lot more than that. It all depends on what skills they think the person has that's reading that. And all the new ones, of course, take long, like the Health Act. Those are just horrendous. And those are still totally screwed up. And so there'll be, I expect to see, hundreds of notices coming out. Right now the IRS can't even get straight when you send your check in with your tax return on time. They're sending back notices saying that you owe another $12, $15, $29 because your check got there they cashed it on the 25th of April, but your return was there on the 15th, and the two went together. But they don't look at that. They look at, because what they do is when it comes in, if there's a check, they pull it off and send it to another department. Yeah, and so they don't know that, so then we end up writing a bunch of letters saying, here's the proof that these were all sent in at this time, and then they'll, knock it out, but it's still a lot of work on their part and on ours, for no particular reason. That's why this year we did all of or most of our extensions electronically, and that still doesn't look like it's working. We still seem to be getting them. What? You're mean. Anyway, I'm done. Anyway.